Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're talking about HITI's Q3 results. Now sorry this video has taken me such a while to get uploaded. My full-time investing job often sees me working crazy hours and the last week's just been another one of those 120-hour weeks. I'm sorry, but this video is hopefully worth the wait because I don't think this is one you want to miss. As always, we won't just be reading the results to you, you can do that for yourself. We'll be analysing them a little and seeing what this means for HITI both in the near term but also in the longer term. As always, we'll be covering a load of things that nobody else is talking about too, so stay tuned. Please smash the like button. In our battle against clickbait on YouTube, it's so helpful in letting the YouTube algorithm know it doesn't only need to push the sensationalist content. It's not helpful for the investing community on YouTube in the long run, and by smashing the like button, it massively helps the channel. Please keep it up, thank you so much. If you're new to the channel, then make sure you're subscribed. If you want to learn how to become a better investor, then check out the Patreon. There's a new Patreon-only video series on there, which explores what the professional investors do and how to generate better returns. There's also a load of other investing-related content on there, so I recommend checking it out. As always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So HITI announced its much-awaited Q3 results last week. These are the first set of results filed as a Nasdaq-listed company, and it came hot on the heels of new analyst coverage for the stock. In summary, the results were good. Revenue growth of 99% to $48.1 million for the quarter, 75% gross profit growth, and another quarter of positive EBITDA, something which many of its competitors are not doing. However, the market, and when I say this I mean a specific segment of the retail investor base, was left a little bit disappointed in them. I can see why, if looking at the headline figures, despite posting strong revenue growth, the EBITDA was lower than in previous quarters, and without really digging into the detail and the data, it may seem that the company is just not performing. Now before I jump into the more detailed analysis and explain why this is not the case, I do want to add that this is definitely not the case at all. Yes, analysts forecasted larger EBITDA for the quarter than the company delivered. However, there's something here which is fairly simple and which was overlooked. Looking at the analyst forecast, all of them, including those which initiated coverage on the stock in the last month, neglected to include the greater costs which came with being a Nasdaq-listed company. This includes greater Nasdaq fees versus the Toronto Stock Exchange fees, greater fees associated with the audit, higher insurance required. There are a load of buckets of other costs which come with being listed on the Nasdaq which it didn't have when it was an OTC stock. Now, I hold my hands up as well. Despite mentioning this dynamic on the channel some time ago, in my predictions within the Patreon group, I also overlooked this dynamic, and so I made the same mistake as the analysts here. We did anticipate some of the margin contraction and margin erosion, but not for this reason. Now clearly this is something which the company would have given guidance on to the analysts and investors, but unfortunately it was not picked up on, and so on the face of it, it does look as though the company has missed its earnings targets. They haven't really, because actually it was a mistake on the forecasting side more than anything. Now the best way to think about this is by making it as comparable as possible. If the same listing costs had been relevant in the Q3 period for 2020, then EBITDA would have been much lower for that period, and the company would have demonstrated strong EBITDA growth for that period. Same as well for the earlier quarters this year, it stands true. The key here is comparability. Yes, there may be an increased ongoing cost associated with the business, but this is new for this period, so excluding this, there is underlying EBITDA growth. Yes, these costs will be permanent for the business, but what will come with it is a whole load of advantages and positive dynamics for shareholders, so we definitely shouldn't be looking at this negatively. Just look at the growth in institutional investor ownership since the uplisting, so the positives definitely outweigh the negatives in this regard. So let's focus on the revenues, the top line first, before we talk more about the cost base. Revenue growth was strong, and investors can find little to fault here, especially in light of consistent quarter-on-quarter revenue growth, and with that, strong market share growth. Now, market share here is important, especially given the competitive dynamics at play in the market. We will touch on these in another video too, because it's a really important point and it does warrant a proper discussion. However, the market is becoming increasingly competitive, and an impact of this is greater margin pressure, specifically on the gross margin line. Now this phenomenon is something which has been developing over the previous quarters. Indeed, it's something which Raj has mentioned during the previous results many times. However, the result of this competition is the margins becoming depressed. This dynamic can't last forever, and an equilibrium will be reached. How, you may ask? Well, ultimately it comes to the fact that the smaller operators and the independents will likely be forced out of business. The most efficient operators and the largest, and those with the deepest pockets, will be the ones that prevail and survive, and the market will consolidate with a smaller number of operators, will generate a normalised level of margins and better profits than they can currently. The key to this whole dynamic is scale and market share, both of which HITI has, and both of which it has demonstrated growth of during this last quarter. So these are definitely two positives which investors should be taking from the results. HITI's business mix is also something which is important here, as it provides a great degree of defensibility against these dynamics too, especially with the much higher margins generated from the e-commerce side of the business. Now, the creation of HITI's value proposition is also massive, and it's great to see. Not only does it enable them to capture a slice of the value segment, which is growing very rapidly, it also means that entering this market won't cannibalise HITI's price point through its multi-brand approach, and ultimately it will ensure that the business does not become associated solely with the value segment of the market, depressing its margins. As a quick side note here, the rapid growth in the value segment has been taking share from the broader cannabis market. However, it's also been taking share from the illicit and illegal market as well. Ultimately, the market currently is in a land grab state at its current point. It's essential that HITI captures the customers and retains them through whatever means and whatever strategy is necessary. Many other competitors aren't doing the same things, and they are losing market share. When it comes to it, it would not surprise me in the slightest if we saw a number of these competitors over the next 6 months or over the next year or so also developing their own value propositions. However, by that point, it may be too little too late. However, HITI is uniquely positioned in this regard to capitalise on this opportunity. It has established and recognised brands, an extensive supply chain and operations, the scale and expertise from a brick and mortar retail perspective, and also the cash flow generation from its e-commerce presence. This is exciting, and this is something which investors, whether new or long-standing, should be excited by. So now let's discuss the poor stock price performance since the results and the potential reasons for this. The main point here is that the selling, based on volumes and timings, is driven by retail investors. The YOLO ETF had its largest week in terms of volume of HITI shares bought in the week following results, which is a sign of the continued commitment of institutional investors and ETFs, despite the results. Unfortunately, this comes down to the mindset and lack of patience among many retail investors. Many of these investors are likely to have exited their position for a loss or generated highly suboptimal returns on their investment, and really this can quite easily be avoided by just practicing some discipline. Now, I have another video coming to the channel in the next few weeks where we will discuss all of this in detail, but I have said it consistently in relation to every video on HITI that this is a long-term investment. A lot of this comes down to psychology and investing experience. When in a position which is based on a thesis, there's no defined exit point for your investment, and you need to accept and be aware of the fact of that journey that you're on, and that your position and its value is not linear, and that for a period of time it may be underwater and it may be in the red. If this is not something which you have the appetite for, or you're unable to stomach such dynamics, then you should find another style of investing, as you will struggle to generate returns with this strategy if it's something that causes you such concern and discomfort. There's no shame in that whatsoever, it's just the basis of what kind of investor you are. A lack of patience here has cost a number of retail investors, while at the same time the institutional investors are building their positions. Be patient, know what you've invested in and know what the plan is for the coming years. If you're sitting here struggling with the current movements now, then I can assure you it won't get any easier over the course of this investment. Thesis-led investing is never a clear, linear line from your entry to exit point. It's always a bit of a journey. Ultimately, it's a long-term play, and it won't make you rich overnight. Another really important point to discuss here is also in relation to the relative performance. Clearly the market has been hit hard over the past week, the Evergrande situation being a driver of this, but the relative performance is also really important to keep in mind too. A lot of other players in the sector have also been hit hard, and so the relative performance to them versus those players is so critical, and again it's something which we will discuss in another video coming to the channel soon. However, it's important because it influences how the ETFs and other fund investors may approach their investment strategy towards HITI in a positive way for HITI investors. Now, another point here is that anyone who has been invested in HITI for any period of time should be used to this dynamic anyway. The results get released and immediately, regardless of what the results say, we have a period of negative stock price performance. Typically the results are overarchingly positive and it's followed by a sell-off. It's the impatient retail investors who are getting hurt here, not the institutional investors who are taking advantage of that. Not the institutional investors who are taking advantage of this dynamic and growing their position. So there are three more really important things here to discuss about the earnings which I've not seen anyone else really touch on at all. The first of these is the revenues being generated from the data side of the business. Now this is something which I've said from day one in HITI really excites me. The insight and data collection which HITI had access to is unrivaled, and there's a very real and growing commercial demand for this information. During Q3, HITI generated revenues of $3.8 million from this business line during this quarter alone, versus just over $600,000 in the Q3 quarter of last year. This is massive growth, but mark my words, within the next 5 years' time, this will be a multi-million EBITDA generating division in its own right, and which adds even greater resilience and diversity to the overall high tide business, and most importantly for us as investors, flows down to profitability and stock valuation. Now the next thing to talk about is the wholesale division, and this is a slightly less positive update. Now clearly the disruption to global supply chains caused by COVID continues, and this causes issues for any business which relies on an international supply chain. The wholesale part of High Tide's business does, and this continues to be impacted. It's small and the business is very diversified, and it's diversified enough for this not to be an issue, but it's the one negative that could be drawn from these earnings if one was looking for something. Now personally, I'm sure that once supply chains are fully restored and are operating as efficiently as they were pre-COVID, that this will be resolved, but for now this is something to bear in mind. Now the final point which I'm going to leave you on here is the potential M&A. Now during the management call, Raj talked about a potential acquisition that's coming fairly soon, potentially in the e-commerce space. Now he mentioned it a few times, he sounded very excited, and personally that makes me excited as well. I really can't wait to see what he has up his sleeve. If it's another highly accretive deal with a bunch of value creation through multiple arbitrage and a clear strategic rationale, then it definitely gets the thumbs up from me. Anyway, thank you so much for watching, I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel, then make sure you're subscribed, and check out the Patreon for a load of other investing related content. As always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different thoughts and opinions, so please get involved. Thanks again for watching, and I'll see you in another video.